Hi everyone, welcome back to this series of ASX Market Watch videos. This one is a really special one because we're actually going into the 5 principles that I've come to the conclusion of over my years of trading and investing, and also the years of trading and investing where I've become a profitable trader. So I just wanted to share these 5 principles that might be able to help you to get to that stage in your trading as well. They're really fantastic. Let's just jump straight into them. The first one, there's 5 obviously. If we just do a quick flick through, there they are there. Really, really simple. The first one, and it is also a convenient hashtag, of course. So we've got invest or die broke. But this one is so important because, talking around the water cooler, at your job or at the street or at the supermarket, talking with normal people, most normal people do not really think about investing. And this is just going to be the downfall of so many people in a few years' time. The reason is, and as you can see on that card, a difference of 10% per annum is worth $1.2 million to you personally over 20 years. So that's the magic of compounding. In other words, you have to learn to invest or face the consequences, and you'll be at the mercy of other people who may not know what they're doing either. All these advisors out there don't necessarily know that much either when it comes down to it. They might know a lot about tax and that sort of thing, but investing is another matter. This one I've got just a regular sort of a hypothetical portfolio, $50,000. If we were to look at that over 20 years and 7%, it ends with $193,000 over 20 years. Now, if we were to make that 17%, so just that 10% per annum difference, we're looking at over $1 million. So that is why we must invest or face the consequences and die broke. The second one is anti-spruiker. Again, a convenient hashtag, but in all seriousness, there are still people out there who are more salespeople than actual traders. You'll find people selling trading systems or even just vague methodologies for $10,000, $15,000, $20,000, and these guys they're more salespeople. And they're interested in making the sale. They're not making their money from actual trading or investing. So beware these salespeople who have not automated their tests or even tested at all. They can say anything, and they usually do say anything. Ask for actual proof. This will save you so much heartache down the track, I promise you. And looking at AmiBroker, which is the program that I use personally, you can test these things. You can do a quick back test, and you can get a report as easy as you like. Look at that. We've got very, very simple equity curve. Obviously, I would recommend that the person, if you are buying a system from someone, that they do a Monte Carlo test as well, which involves 1,000 random variations of that of their particular system, just so you can see the variation that might happen, because not everyone is going to take the exact same signals in the exact same way. Anyway, that is really important, and it's such a great one too. The next one is another, quite a simple one, but also very important. Validation rules. In other words, if you don't have rules for entering and exiting the market, which not many people do, then you can't validate your trading system, just in the same way that we saw here. Obviously, it's good to be able to validate your system to see that it's going in the right direction over, many, many years, and obviously to see the different variations of that system as well. So if you don't have your rules, you can't validate them, and if you can't validate them, what will happen when everything hits the fan, or the market starts to melt down? Obviously, these are the times when the emotions run high, and you'll probably break your rules, if you have any, and do the wrong thing because they haven't been validated properly. So, that can cost you a lot of money. I definitely recommend having solid rules that have been tested thoroughly. The next one is a sort of offset of that, and that's downside deviation. Now, it's a fancy word, but all it means is that if something goes up really quickly, then it can also go down really quickly as well. You see people who might be looking at stocks, and in fact, there's a great example here on the ASX. Wow, well, obviously, this is the downside part of that deviation, but if you look previously, so there we go, we had people screaming. They were like, I'm making so much money in this stock, it's gone from 50 cents up to $5. And then obviously, you've got over this side, within a couple of months, it's dragged all the way back down to that dollar area again. So what goes up can definitely go down. And the main thing behind this is do not, or I personally do not borrow money to invest. And the reason is, if you're trading with borrowed money, it is much harder to stick to your rules at the critical times. And obviously, if that happens, you'll break your rules. Potential is that you'll lose more money, and or you won't be sticking to your system, which is proven in the markets as well. Now, the last one is number 5, simple wins. It doesn't have to be complex, but it just has to be checked and validated. So there are 2 ways to trade: trend following and mean reversion. And yes, that does apply to fundamentals in the market as well. What is trend following? Trend following is following the growth, is buying into strength. So you're buying as a stock is going up, or as the earnings are going up as well. Mean reversion, what is that? That's when we buy when the stock falls. Or in other words, when your fundamental investors might be seeking value out of the stock in the hope that it actually rises again. So that's your mean reversion. And it applies to pretty much everything. That's really the only 2 ways to trade apart from your buy and hold. And the point with this is that you find one of these methods, whichever one it is, and make sure that it suits your time needs. And obviously it needs to suit your temperament needs as well. So simple wins, keep it simple, make sure it's validated, make sure that you're not borrowing to invest, look out for the spruikers and make sure that they've actually validated what they've done, and above all, just get in there and invest. Otherwise, you may have to face the consequences and die broke. Those are my 5 principles. Please tell me if I'm sticking to them or if I'm not. I definitely need to know. Hold me accountable. But also feel free to take on any of those that match with your personal psychology as well. Guys, thank you so much for watching. Have a great week. Happy trending until we meet again. Bye for now.